Hello and welcome to Investing Confidential. For the few of you who have been watching my videos, you will know that this is not surprising. I call the top of the S&P, but most importantly, as I said, and I'll say it again, November 5th, the election was a turning point for the US, no matter who won. This is predictable. Nobody is addressing the deficit. Trump's not. Kamala Harris wouldn't. And you're getting the predictable outcome. It didn't matter who got elected. The markets were going to crash, right? It's inevitable. It was inevitable because nobody in Washington wants to deal with the most important thing, the out of control spending and the deficit. Nobody. Even Trump. Nobody. Right? He's trying. I mean, in one way, he's trying to cut. He needs Elon Musk to cut because he wants to continue the tax and he wants to cut taxes even more. So he needs to cut. But he's not going to cut back spending, overall government spending, because of what he wants to do. He wants to lower taxes, and you need to cut costs to lower taxes. There's nothing left, but you have to address the deficit, which he's not, and nobody wants to. So the outcome of what's happening in the marketplace, as I've been talking about, nobody listens to me, but I'm talking about, is the reignition of Main Street versus Wall Street. I give Trump that. Okay, he wants the Main Street to outperform Wall Street, and by default it is. Maybe you can't see it in the short term, but Wall Street's screwed. When I say Wall Street, I mean financial assets, right? The assets of the globalists, financial assets, stocks, bonds, real estate, but more stocks and real estate. This is where the wealth. This is what is the wealth gap. All these problems that we see around the world are related to the S&P 500 and the real estate markets around the world. That's it. But the S&P 500 is the biggest culprit. And for those, again, who have watched, you know that I firmly believe the S&P 500 is a joke. The index is a complete joke. It means nothing except that it has covered up what has been a recession in this country for the last 4 years. Okay, you can't see it because if you own the S&P 500, it's irrelevant. The S&P 500 is a component of GDP. Yes, it is. So the S&P going up 20% a year, 25% a year covers the crappy economy we've had. If you've owned stocks. Now, if you haven't owned stocks, which is 90% of the population in this country, you've watched your assets erode, whatever assets you have erode, your buying power, more importantly than anything, your buying power erode, you're going further into debt. And look, I'm a conservative, and I'm telling the truth. Healthcare costs are out of control. Real estate's unaffordable. And the stock market is, for most people, not me, but for most people, they don't understand what's going on. And then now you're seeing the Dow down 1,600 points, the S&P down 4%, NASDAQ down whatever. Folks, I'm going to tell you right now, the word tariffs, this whole thing with tariffs, which is what media's talking about, this is a sideshow, an absolute sideshow. It's meaningless. Now, when I say it's meaningless, I'm meaning the outcome is. Because at the end of the day, the only thing that matters is the inflation cost, the cost of goods and services, jobs. I mean, this is what an economy thrives on. And the economy has not thrived on this. It has thrived on the S&P 500. Only. Nothing else. Nothing else. So an economy that goes up because of the stock market is not an economy. It's a bubble. We've had a massive bubble. The biggest bubble ever. Ever in history. It makes 1920s look like a sideshow. So the tariffs, folks, are irrelevant. Okay? They're going to go up, they're going to go down, he's going to play games, he's going to say this, he's going to say that. It's a market, it's a ploy, it's a trading ploy, which is smart to a certain extent. But it doesn't matter because he came in too late. We have 36 trillion in debt, 2 trillion deficit every year. No chance of ever cutting that down. I give him credit. I mean, the other administration would have done nothing. It would have been even worse. But let's dive into it. So, I mean, at the end of the day, what's going to happen here? Okay, so the mainstream now is coming out and telling you that the recession odds are great. We're going to have, 46% chance now of a recession, 50% chance of a recession. Okay, normal expectation is 25. Look at this. This is horrible, right? This is what the mainstream press is. But when we had in 2020, we had, right around COVID, we had 2 negative GDP. They said there's no recession. Where we had inflation going through the roof, wages hadn't budged. They told us there was no recession. But for the working class people in this country, for 90+% of the Americans, we have been in recession. So this is a joke, because this is only the numbers. It's meaningless. And we saw, I mean, if you have been listening to my videos, you know that all these government numbers for the last 4 years or last 3 years, I've been talking about this, they're all fake. And it's been proven they're fake. Okay? So this is the only thing that matters. This is the voting, the poly markets voting. And what this is telling us is that this is the real stuff. These people betting on this stuff. It's telling us that the odds of recession are greater than 50%. It's going to happen. The betting markets, much more reliable than the GDP or the forecasters, Wall Street. They're going to lie to you. They've been lying to you ever since. They're going to lie to you. So the betting markets are telling you the recession is baked in. Again, whose recession is it? Now here's the Fed, this worthless GDP now. Everyone's jumping on this GDP now. These guys were never right. They're partisan, by the way, incredibly partisan. But let's look what they're saying. They're now forecasting almost a negative 4% for GDP in the first quarter. For the first quarter. I mean, it's not going to be down 4%. But this is partisan politics. This I don't know who runs this Atlanta Fed. I don't care. But they were forecasting rosy GDP last year when they didn't come close, and now they're forecasting the doom and gloom. So this is a partisan. It's worthless. Because at the end of the day, we have been in recession for years. Real recession. These numbers, CPI, GDP, they're worthless and fake. Okay, meaningless. What you need to look at is what's really happening, and what's really happening is dangerous. Is not good. Okay, here's consumer inflation expectations. Right now, this is expectations. Okay, this is not real inflation. This is expectations. This is very interesting. So what has happened because of the media talking about tariffs, is everyone expects inflation to go up. Folks, inflation is not going to go up as much as you think. We've already seen a lot of the cost of basic goods going down. Trump has to keep oil down. He's going to pummel oil. Okay, that's going to keep inflation down. Remember, the components of oil and petrochemicals isn't everything. So as oil goes down to 50, that's Trump's target. And there's no doubt, you can't deny it now. He's been right. Everything he wants to do is happening. So oil's going to 50, folks. And so inflation is not going to be, the expectations are way too high. But it's going to be up, but it's way too high. Way too high. But again, this is the expectation. So it harms the economy because this is a consumer economy. Right? And you know, in the mainstream media is picking it up. Consumers tapped out. We know that. Completely tapped out. They've been tapped out for quite some time, but now the media is writing about it. And, you know, you have, whether you look at credit card receipts, we've been talking about that for quite some time, through the roof, trillion, over, I don't know how many trillion, 1.6 trillion in debt. This is insane. Credit cards, insane. It's like the government. So the government's in debt, so the consumer's in debt. And now, with expectations low, what happens? People pull back. People pull back, and ergo, recession in the numbers. This is only a recession in the numbers. The numbers are the numbers. They're meaningless, but that's what you're going to see now. The media reports on the numbers. And so that's going to cause a lot of problems, because here we talk about, again, these are expectations. Debt delinquency. We're going to surpass 2020. So I go back to what I said before. You have to go back to the pandemic was an inflection point. Many stock markets have tested the pandemic lows, like China and others, and now they're going back up. I predicted that every stock market will test the COVID lows at some point. Okay, may happen, may not, but COVID is the inflection point, just like the election in November is an inflection point. And the inflection point of COVID turned out to be a positive inflection point, because you had an incredible compounded return on financial assets since the bottom of COVID. That wasn't a bear market. That wasn't a recession. That was a blip. It's a blip. And here we have delinquency expectations. And the reality is delinquencies are rising rapidly. And what happens when you have this survey of delinquencies? What the banks do always at the worst possible time is they contract credit. They're going to look at this and they're going to say, oh, well, we're contracting credit. So the only people that can borrow are people that don't need the money. The people who need money, the small business, the consumer, you're out. And then it just spiraled lower. Okay, so this isn't good. Now, these are all signals that you're not going to see in the government numbers, but they mean more than the government numbers, because now you have CEO confidence, and CEO confidence is now below pandemic levels, a lot lower than pandemic levels. Obviously, you had the lowest during the great financial crisis, but we're pummeling. We're falling like a falling knife. That's not good, because when CEOs, what happens then is this: CapEx. CapEx turns negative. What does that mean? That means companies don't invest. There's no research. And that, again, combined with the bank's restriction, consumer confidence, it all leads to a tumbling of an economy. And this is what is happening. And then you can't get away from this. I mean, this trade deficit we have is just the worst probably in history, caused by many different things. But the only thing to look at this is that it was the trade deficit that caused probably the biggest crash in my lifetime, which was 1987. I was young, very young. Stock market, S&P was down 24% in one day. That was caused by a massive trade deficit. And we just had a number come in, and now we're seeing big time corrections in the market. So just focus on when trade deficits go down, it's not good. Okay, but again, what's looking through everything else, what's the most important thing? The important thing is Trump needs two things. He needs oil to drop to cut inflation. He needs the dollar to be weak. He's not going to say it, but he needs the dollar to be weak. Why does he need dollar? Because the dollar weakness is a way to offset large amounts of debt. This is a classic IMF emerging market playbook. Those who have traded emerging markets know the way out of your problems is devalue your currency. That's it. So I don't know who's giving him this advice, but this is classic. And the biggest problem today we have in the markets is two things. First is the Fed most likely is not going to come in to save the day, because it's going to take a while for the move in oil prices to really affect inflation and cause deflation. But in the meantime, the Fed's on hold. There's no Fed put anymore. Fed is not going to bail out the stock market. Though Powell is a slave to the private equity, he's not going to bail out the stock market. He can't. We know he's partisan because he cut rates before the election, never should have cut rates. And now he's suffering for that rate cut. So there's no rate cuts coming. There's no Fed put at all. They can't. And then the other thing is, it's very simple. Apple, any of these companies, any of these global companies, Microsoft, any of these companies, why are they getting pummeled? Because they say it's earnings stupid. It's earnings expectations. You have companies going from that offshored everything, from paying living wages and high rates of insurance, very expensive to have workers here in this country. So what they do? They picked up, went overseas, went to Asia, went to South America, saved money, get their stock prices up. And now they're being forced to reshore. If you're a globalist and stock market person, you hate it. But if you're 90% of the population in this country, hey, bring it back. I don't care. Do you care if Apple makes 80% EBITDA margin or 70% EBITDA margin? No. That's cash flow, by the way. No, who cares? You don't care. Who are you? Instead of making 100 billion, you make 80 billion. What do I care? And you shouldn't. You shouldn't. Honeywell, anything. It doesn't matter who it is. General Electric, Ford, General Motors. 90% of the population don't care if your earnings come in $2 versus $1.50. They don't care. They don't care because you're an American company and you should be working in America. Because guess what? That's where every other country works that way. You think the Chinese will allow their companies to pull out and hire Vietnamese workers because they're 50% cheaper? No, not going to happen. Doesn't happen in Europe either. Cars that are sold in Europe, manufactured in Europe. They're not manufactured in China. Many of the auto companies in Europe, don't feel bad for them. Mercedes probably make more of their cars for the US market here, same with BMW, than they do in Germany. Toyota, Honda, manufacture here. General Motors and Ford, they're the ones who shipped everything over. Now they're all coming through Canada and Mexico. But that's over. That's over. But it's going to take a while for manufacturing jobs. We're already seeing, by the way, there's evidence of it already. But it's going to take a while. And Trump is playing, he's playing Russian roulette. He needs to knock this economy into a numbers recession. We're already in recession, but the numbers needs to deflate. How do you deflate? Stock market. Knock the stock market down 20-30%. It's already down 20. Knock it down hard, fast. Because in the fall of 2026, there's another election for Congress. And if the economy isn't recovered by then, he's done. He's done. He's got a year and a half left, essentially. So if you're smart, you hit the economy now hard, very hard. Knock it hard, deflate it, and then try to inflate it back. Not inflation per se, but get things moving again. That's the bet. So tariffs are just a sideshow, means to an end. But again, if you look at the stock market, you look at it here. I mean, even this is a snapshot, not too long ago, but even today, the U.S. market's still over. Look how overvalued it was. This is a few weeks ago. So the little orange thing is the current valuation. The range is in the blue. Right? So, I mean, and the little gray is median. So the U.S. is probably the most overvalued it ever was. No doubt. Europe, a little bit overvalued. Japan, cheap. United Kingdom, very cheap. And even with this correction today, the U.S. is still overvalued. Still overvalued. So is there more pain to come? Yeah, of course. But we don't know. Tomorrow the market could rally 1,000 points. It's irrelevant. Recession is coming. In fact, for most of Americans, it's already been here. But it's going to hit, again, going back to the theme, I'm going to keep pummeling it. Financial assets, Wall Street versus Main Street. Wall Street's days are over. Next, there's another big bubble about to pop and kick Wall Street right in the teeth, which is private credit. I've talked about it before. Wall Street was expecting a huge win this year with IPOs. That's done. And so the death of Wall Street is going to be good for Main Street. Because Wall Street is not the friend of Main Street. They're not. I'm an insider, I know. Not. And when I talk about the next video, I'm going to talk about private credit. It's scary what they're trying to do. They want to ram this junk garbage down your throat because nobody wants it. They're going to ram it down your throat. They're going to try, but don't let them. So, tariffs, it's a negotiating ploy, but the result of all this negotiating is worried consumer, reduced capex. All of these things are leading to what is going to be a recession in the numbers. Not going to hurt the 90% because we've already been in recession, right? I say we, but that's the reality. So, do you buy here? If you're a trader, maybe, but as I said before, this is I think fixed income bonds are still a place to be. As you guys know, I've been a big bull on gold for 2 years. Gold continues to go higher. Wouldn't probably buy it here at this point. But the action is in non-dollar assets, commodities, certain emerging markets. I'll go into this deeper, but the big winner on tariffs, if you want to position yourself as the big winner, it's Latin America. Not even close. Not even close. I mean, the new Mexican president, as I spoke about, she's playing this perfectly. Mexico is the place to be. Mexico's going to boom. Now Brazil's going to follow it, and Brazil will be delayed, but because Brazil's got a lot of political issues with the whole Bolsonaro and Lula is basically like Biden. He's sick, 82 years old. He's out of it. He's done. They need to put Bolsonaro in prison. So, you've got this political stuff that's going to hold some Brazilian assets down. But Mexico will explode. Colombia, Peru, believe it or not, Chile, Argentina. These are the places that are going to have superior returns. There's ETS for all this stuff. There's also a lot of ADRs. So, non-dollar assets, I've been saying this for a while, that's the place to be. The U.S. has had its day. Wall Street's finished. Financial assets in the U.S. And by the way, real estate will follow these indexes lower. It's already going down. But people are going to bite the bullet, especially foreigners and especially hedge funds who own all the single-family homes. Don't believe anyone that they don't own any. They own all the delta, single-family home delta. They'll be puking very soon. And real estate the American dream will come back in a few years. It takes a while. So, topsy-turvy. Everyone in this, every hedge fund, every young hedge fund trader, all the retail Robinhood crowd, they've been taught to buy the dip, and they're going to buy the dip, and they're going to get pummeled, and pummeled, and pummeled, and pummeled every time they buy a dip. And when they're gone, when they've given up, you'll get the trading bounce at that point. But we'll see. So, if you're a trader, if you're an investor, as always, especially now, be careful out there.